Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. What's on our minds for 2012? Well, the big thing is going to be what is going to happen with the net interest margin. People talking today that the Fed may come in with another round of easing, buying what is estimated to be $550 billion worth of mortgage-backed securities. What happens if that the prepayments start to pick up in terms of the investment portfolio or even in your mortgage portfolio? What happens if? That's what we're all concerned about in this period of low interest rates that doesn't seem to want to go away. But the proof is in the pudding. And interestingly enough, based upon third quarter numbers, is that these are all the community banks across the nation in terms of their net interest margin over the past many quarters. And what's really interesting when we look at this is that we have not seen this margin squeeze yet. We've not seen anything happen that would indicate on an overall basis in the industry that the margins are actually going downward. In fact, in the last quarter, we actually had margins head up slightly. So we're not seeing the squeeze yet, but it's on every community banker's mind that this is probably going to happen once again as we move into 2012. And the reasoning is interesting and is not what you think. One is we know that we've been able to cut the cost of deposits in here. And you know my feeling is that based upon where T-bills are, we need to be continually cutting those cost of deposits in here, and that may continue into 2012. But as many community bankers remark, how low can we possibly go and when we hit some sort of bottom? But the interesting thing was yield on earning assets in the quarter. Look at this. 2 constant quarters where yield on earning assets have remained relatively the same. So we have continual move down in cost of funds, and at the same time yield on earning assets, surprisingly enough, has remained constant. So what do we do in here? Well, one of the significant problems coming this next year is really in terms of loans. And when we look at loans in here, that they are moving down in terms of overall duration. And you want to have a real handle on this in your particular bank. You want to be able to have the ability to model this, to sit there and say, what is the duration doing on our loan portfolio? Because remember back when the economy was booming back in 2005, 2006, 2007, is that a lot of banks were putting on 5-year type commercial loans. And when we think of that in terms of the refinancings that have been happening, could continue to happen, what that is doing is bringing that overall duration down. In fact, in many banks, what we're seeing is that their duration on their liability side is actually now longer than on the asset side, which is good news if interest rates could rise in here. The regulators, of course, are worried that if interest rates go up, and they're doing in terms of doing 400, 500 basis point shocks, what happens to a bank? It could be the best thing that could happen to see interest rates move up, because if the regulators really realize what has happened to the majority of banks' balance sheets in here in terms of this duration mismatch that's occurring, is that most community banks would prosper well if interest rates did move up and move up quickly. But once again, the expectation that we all have, and the Fed has underlined this, is that short interest rates will remain low as we move into 2013. So under that, and those shortening durations mean that banks are going to have problems coming up in 2012 in terms of asset yields starting to decline in here, maybe at a faster rate than deposits. Once again, it goes back to, and I can underline this over and over again, the ability to really dynamically model that balance sheet, to really understand what the components are, so that once again, one can be proactive. Doesn't mean that you should look at certain loan types to try to grow them. For instance, if that refinancing boom occurs, do you have the ability to actually portfolio mortgages? What type of mortgages? What are the amounts? The other side, which we talked about last week, is the tax-exempt securities remain very cheap in here. Can you use that to offset, and in what amounts can you use that to offset a possible margin squeeze, to offset that? How much more do we need to cut our cost of funds in order to offset what is happening in the overall loan portfolio? So once again, planning ahead, looking at 2012 from a dynamic modeling perspective, I think is very important, so that we continue to see that net interest margin, like we saw with the national benchmark group, remaining constant as we go through 2012. This is Jay Brew, co-chairman of Seafried & Brew. Have a good week.